Okay, welcome to Devon Trade. I'm Devon. Today I'm going to talk about liquidity speed. So liquidity speed are one of the most critical concepts for any trader to understand because they explain why false breakouts occur, how smart money manipulates, price to trigger stops, why these moves are necessary for large positions, and how retail traders can spot them and profit from the reversal instead of being trapped. So in this episode, we will define liquidity and liquidity sweeps, explain how institutions use sweeps to create traps, describe why sweeps are essential knowledge for consistent profitability, walk through how retail traders can turn these movements into reliable setups, and finally, outline several real-world example scenarios you can show on the chart. Liquidity simply refers to the cluster of orders sitting at specific price levels, stop losses, breakout buys, limit orders, and pending orders. Whether large numbers of traders agree on the level, liquidity pools form, and these pools become magnets for price. A liquidity sweep happens when price intentionally spikes into one of these pools to trigger those orders, collect the liquidity, and then reverse. You usually see this as a sudden wick above the key high or below a key low. The spike is not a real breakout. It's a hunt for orders. Smart money, big institutions, market makers, and algorithmic liquidity providers needs large chunks of liquidity to enter or exit positions. Retail traders, because they place obvious stops and breakout orders at the same level, are intentionally provide that liquidity. Institutions will push price just beyond a high to trigger breakout buys, or just below a low to trigger stop loss sales. This creates emotional reactions that make retail traders think a move is real, when in reality it's manufactured to fill the opposite direction positions of larger players. Understanding liquidity sweeps is essential for becoming a consistent trader because they explain the majority of false breakouts and sharp reversals. Without this knowledge, traders repeatedly buy the top of a sweep or sell the bottom of a sweep, thinking momentum is starting, only to get instantly trapped. Once a trader understands that the sweeps are part of the market's design built into how liquidity providers operate, they stop reacting emotionally to these manipulation candles and instead anticipate them. Retail traders can use liquidity sweeps to generate profits by learning to identify where stops are likely to cluster, waiting patiently for price to sweep those levels, and entering only after the sweep confirms rejection. The process is simple. Identify liquidity pools at previous highs, lows, equal highs, equal lows, or range boundaries. Let price take out that level. Watch for rejection or displacement signaling a reversal, then enter in the opposite direction of the sweep. The stop usually goes beyond the sweep week, and the target becomes the next liquidity pool. For real-world examples, you might show the speed of a previous high where price weeks above triggers a breakout bias, then dumps sharply, or the speed of a previous low in a rising market where price quickly dips below the low, clears the stops, then rallies, or show the range where both the high and low are swept before the real move starts, or show the pair of equal highs that get swept before a major reversal. You can illustrate these scenarios live on your chart to reinforce how predictable this behavior becomes once you know what to look for.